Hey everyone, welcome back to Corporate Decoder. Datum One Series Trust just filed their N-CSR report detailing their financial performance up to the 31st of March 2026, and I'm seeing some interesting shifts. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing reveals a significant reorganization and provides a snapshot of how these infrastructure funds are performing. Alright, let's dive into what this filing is all about. This is essentially an annual report for investment companies, and here we're looking at Datum One Series Trust, which includes two main funds, the first Sentier Global Listed Infrastructure Fund and the first Sentier American Listed Infrastructure Fund. A big event happened for these funds just before this reporting period. In November 2025, they underwent a reorganization, moving from Advisors Series Trust to Datum One Series Trust. This also involved changing their fiscal year end to the 31st of March to match the new trust. Now let's talk about the money for investors. What does it cost to have your money managed? For the first Sentier Global Listed Infrastructure Fund, the cost for this 5-month period based on a hypothetical $10,000 investment was about $35, which works out to 0.80%. For the American Listed Infrastructure Fund, it was slightly less, around $33 or 0.75%. Remember, these are costs for a shorter period, so the annual cost would typically be higher. Performance is always key. The Global Listed Infrastructure Fund saw a return of 9.04% after fees. This was against a backdrop where global listed infrastructure stocks were seen as less vulnerable to disruption from things like artificial intelligence, and they also showed resilience when conflict escalated in the Middle East. However, this fund actually underperformed its style-specific benchmark, the FTSE Global Core Infrastructure 50/50th Net Tax Index, which returned 9.80%. The report points to an overweight exposure to airports and an underweight exposure to utilities and renewables as reasons for this underperformance. On the flip side, there were some strong contributors. ONEOK Inc, Cheniere Energy Inc, and Targa Resources Corp were among the top performers, but some holdings pulled the performance down. Beijing Capital International Airport Company Ltd, SBA Communications Corp, and Groupe ADP were among the detractors. Now, for the American Listed Infrastructure Fund, it did a bit better relative to its benchmark. It returned 12.48% compared to a negative 4.04% from the S&P 500 index. This fund actually modestly outperformed its style-specific benchmark, the FTSE Core Infrastructure Capped Net Tax Index, which returned 12.23%. The outperformance was largely due to its holdings in the North American freight rail sector, like Norfolk Southern and CSX Corp. The top performers here included ONEOK Inc, Cheniere Energy Inc, and CSX Corp. But again, some sectors hurt performance. Utilities in particular faced political and regulatory concerns impacting holdings like Dominion Energy and Eversource Energy. Let's look at the long-term growth for the first Sentier Global Listed Infrastructure Fund. The average annual total return over 1 year was a strong 18.91%. Over 5 years, it was 7.69%. And since its inception back in February 2017, it has averaged 7.36%. The S&P Global 1200 Index, a broader benchmark, did better over the 1 and 5 year periods, showing 21.03% and 11.00% respectively. Their style-specific benchmark, the FTSE Global Core Infrastructure 50/50th Net Tax Index, showed a 17.98% return for 1 year and 7.77% for 5 years. Now, for the first Sentier American Listed Infrastructure Fund, its 1 year average annual total return was 15.16%. For 5 years, it has been 8.95%, and since its inception in December 2020, it has averaged a solid 10.26%. The S&P 500 index, a broader benchmark here, had a 17.80% one-year return and 12.06% for 5 years. Its style benchmark, the FTSE USA Core Infrastructure Capped Index, showed a 12.34% 1-year return and 7.65% for 5 years. Looking at key statistics as of the 31st of March 2026, the first Sentier Global Listed Infrastructure Fund had net assets of over $145 million. It held 41 different investments. Total advisory fees paid were around $225,000. The portfolio turnover rate was 25%, meaning about a quarter of the holdings were bought and sold within that period. For the Global Listed Infrastructure Fund, the biggest sector is electric utilities at 24.4%, followed by transportation infrastructure at 21.5% and multi-utilities at 15.1%. Ground transportation makes up 13.7%. For the American Listed Infrastructure Fund, the sector allocation is a bit different. Electric utilities is the largest at 29.7%. then ground transportation is at 20.6%, and oil, gas, and consumable fuels is at 17.9%. Multi-utilities is at 16%. We already touched on the major change, the reorganization into Datum One Series Trust. This also aligned the fiscal year end to the 31st of March. They also mention a shareholder servicing plan fee that is currently at 0% and will be until at least May 2027. Scroll effective the 8th of December 2025. First Sentier investors, US LC Center here is something important for cost-conscious investors. Starting the 8th of December 2025, the investment advisor First Sentier investors, US LC, contractually agreed to waive management fees and cover other expenses if the total annual fund operating expenses go above 0.75% of the fund's net assets. This is through May 2027. This is a common way for fund managers to limit investor costs, especially when a fund is growing. A change in accountants is noted. As of the 3rd of November 2025, Deloitte and Touch LLP became the independent registered public accounting firm, replacing Tate, Weller and Baker LLP. Let's look at the accountant fees for the period ending the 31st of March 2026. The audit fees for First Sentier funds were $41,000. For the prior year, it was $35,000. Tax fees for 2026 were $9,000 and $7,200 for 2025. These are relatively small amounts for the overall fund's operations. Now, let's get into the specific holdings as of the 31st of March 2026. For the First Sentier Global Listed Infrastructure Fund, their investment securities are valued at over $143 million. The cost of these investments was about $127.7 million. In the electric utilities sector, which makes up 24.4% of the net assets, some of the top holdings include American Electric Power Company Inc., valued at over $6.7 million, Duke Energy Corp. At over $7.6 million, and Nextra Energy Inc. at over $5.7 million. For transportation infrastructure at 21.5% of net assets, you see holdings like SBA valued at over $4.2 million, Aeroports de Paris at nearly $2.9 million, and Transurban Group at over $5.6 million. In the oil, gas and consumable fuel sector, representing 10.5%, key investments include Cheniere Energy Inc. at over $4.6 million and ONEOK Inc. at over $5.9 million. Shifting to the First Sentier American Listed Infrastructure Fund, their common stock holdings are valued at over $4.3 million, with a cost of about $3.8 million. This fund is heavily weighted in electric utilities, at 29.7% of net assets. Holdings include American Electric Power Company Inc. at about $255,000, Duke Energy Corp. at over $216,000, and Nextra Energy Inc. at over $278,000. Ground transportation is significant at 20.6%. Here we see Union Pacific Corp. Valued at over $456,000 and CSX Corp. at over $339,000. Looking at the statement of assets and liabilities for the global listed fund, total assets are over $145 million, with liabilities around $164,000. The net assets are just over $145 million. For the American listed fund, total assets are about $4.4 million, with liabilities around $43,000, resulting in net assets of over $4.4 million. The statements of operations show the income and expenses. For the global listed fund, over the 5 months ending the 31st of March, 2026, investment income was about $1.7 million. Expenses after waivers and reimbursements from the advisor were around $480,000. This resulted in net investment income of over $1.2 million. Net realized and unrealized gains added about $11.7 million, leading to a total increase in net assets of over $13 million for this period. On the statements of changes in net assets for the global listed fund, you can see a net increase from operations of over $13 million for the 5-month period. Distributions to shareholders were over $10 million. Shareholder transactions, like selling and repurchasing shares, led to a net increase of over $1.1 million. Overall, the net assets grew by about $4 million. For the American listed fund, over the same 5-month period, investment income was about $55,000. Expenses after waivers were very low, only around $12,000. This resulted in net investment income of over $43,000. Net realized and unrealized gains added close to $440,000. for a total increase in net assets of just over $483,000. The statement of changes in net assets for the American listed fund shows a net increase from operations of over $483,000. Distributions to shareholders were about $342,000. Shareholder transactions contributed a net increase of over $316,000. In total, the net assets increased by about $457,000. The financial highlights give us a per share look for the first Sentier Global listed infrastructure fund. The total investment return for the 5 months ended the 31st of March 2026 was 9.04%. The expense ratio after waivers was 0.80%. On the American listed fund side, the total investment return for the same period was 12.48%. The expense ratio, importantly, was capped at 0.75% after waivers. The notes to the financial statements provide more detail. They explain the significant accounting policies, like how they value securities and handle foreign currency translations. This section is crucial for understanding what could go wrong for these funds. Key risks include general market risk, equity securities risk, and specific infrastructure company risks. This means they are sensitive to economic downturns, stock market volatility, and the unique challenges faced by companies that build and manage essential services like utilities or transportation networks. Specifically for infrastructure companies, risks like high interest costs for construction, heavy debt loads, regulatory changes, and competition are highlighted. They also note that unexpected events like natural disasters or political instability can disrupt operations. The auditors, Deloitte and Touch LLP, have given their opinion. They state that the financial statements and highlights present fairly, in all material respects, the financial position of the funds. They also mention that prior periods were audited by other auditors. This statement details why the Board of Trustees approved the investment advisory contracts. They reviewed the quality and extent of services provided by the advisor, including performance history and expenses of comparable funds. They also considered projected profitability and economies of scale. For both the global listed and American listed funds, the board approved the investment management and sub-advisory agreements after considering these factors and concluded the fees were reasonable. So, what is the main takeaway here? These infrastructure funds underwent a significant structural change with the reorganization. Financially, they've shown decent performance in their respective sectors, though the global listed fund slightly underperformed its specialized benchmark. The American listed fund, however, managed to slightly outperform its benchmark. The expense ratios are being actively managed with waivers in place, which is good for investors. The biggest risks revolve around the inherent volatility of equity markets and the specific challenges within the infrastructure and utilities sectors, including regulatory and geopolitical factors. The research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out the Discord.